Inflation may be starting to cool off. July CPI data shows that inflation increased 8.5% year over year, but was down from the 9.1% in June. The producer price index decreased 0.5% in July. The year over year gain was 9.8%. Now, markets have been rallying on the expectation that with inflation not heating up, the Fed may ease up on its tightening. So have we hit bottom in the markets? Has inflation peaked, or is this just a temporary lull? Will the Fed loosen up its tightening, or will it continue to raise rates and sell assets? And how does the Inflation Reduction Act fit into all of this? Well, we have a power panel to break this down and more. Very pleased to welcome to Kitco Phil Magness and Michael Ashton.
Thanks for having us.
Yeah, thank you.
Good to have you, gentlemen. Phil is the Research and Education Director at the American Institute for Economic Research. His work has been published in the Economic Journal and the Wall Street Journal. He's the author of several books, the latest being the 6019 Project, A Critique. And Michael Ashton is Managing Principal and founder of Enduring Investments, a boutique manager specializing in inflation-related products. Very good to have you both with us. And let's start with you, Phil, because some analysts are suggesting that we may have seen peak inflation given the latest CPI data and PPI data. Do you agree?
I tend to be more conservative in my assessment of that. I think they are reading 1 month of numbers that have showed inflation basically flatlining overly optimistically. Without really addressing a deeper structural issue that comes from more than a year, possibly even up to a decade of Federal Reserve mismanagement.
And Michael, what is your read?
Yeah, I think it's interesting that what the downside surprises in this month's number came from very flexible things like airfares, apparel, whereas all of the sticky parts, rents, and things like that continued to be very strong. So if you look at other indices like median inflation or sticky inflation and indices that are supposed to measure, the center of the distribution a little bit better, those are actually continuing to accelerate. I think we'll get a peak, but I don't think we're there in terms of the pressures in those indices yet.
And, even if this is a peak, let's keep in mind that food inflation in July was up 13.4%. The at-home category, which is very, very problematic for most households, it's still a very height of inflation that most Americans are struggling with. So what kind of expectation do you have, Phil, for inflation to remain elevated? How long will it actually take to return to the Fed's target of 2%?
I think the issue here is the Fed is still playing catch up for policies that they should have considered as much as a year ago. We saw them raise interest rates in a couple of very rapid successive moves over the last month or so. But this comes from being asleep at the wheel for the better part of a year, or pretending that inflation was only transitory, was the line we kept hearing from the White House.
Michael, what's your read? How long do you expect inflation to be at these levels for? Some analysts are saying that the Fed is going to be quite content if we get inflation of 5%, which is certainly not what many households would be happy with.
Yeah, I tend to agree here with Phil. We've had money supply go up, 40 or 50%, and prices only 15. So, there's a lot of catching up to do. Our forecast is for inflation for this year to come in the mid sixes. But to stay in the mid fives for 2023. And I don't think that the Fed I don't think that's what they're looking for. And so I think that while the market seems to think that inflation is going to rapidly crash back down to 2.5%, it's going to be disappointed.
Well, I want to get to how the Fed can actually tackle this, but let's first focus on the spin that this number has been given. President Joe Biden taking a victory lap, claiming that inflation was zero. He's referring to the idea that there was no increase from June to July. Let's take a listen.
Today, we received news that our economy had 0% inflation in the month of July. 0%. Here's what that means. While the price of some things went up last month, the price of other things went down. by the same amount. The result, zero inflation last month.
All right, Phil, what's your response to that?
Well, this White House is intent upon wordsmithing its way around economic problems, economic trouble. What we saw in the CPI numbers yesterday was actually just an offset. So the fuel, for example, dropped very rapidly over the last month. But at the same time, food and some other services and other sectors of what's measured in CPI did continue to rise. So he's really kind of capitalizing on the fact that fuel dropped, energy costs dropped, to basically engage in political spin, to assert that the problem is now over, we've solved it, we can pretend that it no longer is a major concern.
Michael,
what are your thoughts on the president's take on inflation?
Yeah, I think if your team hasn't won a game all season, then you take scoring anything to be a positive thing, and I think that's sort of what's happening here. Oh, we got a 0 on the headline number. Let's play that up, but we still haven't gotten a win, and all those things we talked about earlier, rents and car prices and things like that are still really ugly, and I think that I would not expect less, or I would not expect any more of a politician than to focus on the one part of the number that makes him look the best. But that's a pretty thin read. I guess I wouldn't be proud that that's what I'm pointing out.
Well, you have a very accurate read on politicians. You're not very optimistic in what we can expect from politicians. But, Phil, you have gotten into a little bit of trouble by calling out the spin from this administration. I believe that you got into some fact-checking drama with Facebook for saying that a recession is indeed 2 quarters of negative GDP growth as it has long been defined. Tell us about that incident.
That's absolutely. So when the GDP numbers came out just under 2 weeks ago, the Biden administration prepped itself by preemptively trying to essentially redefine recessions, or basically say that the conventional definition that you find in almost all economics textbooks of 2 negative quarters in succession didn't count. So they were basically wordsmithing their way around that problem in anticipation of negative political news. So I called them out. I wrote a lengthy piece documenting the history of this definition and its term, and Facebook slapped a fact check label done by some person with a random degree in journalism on top of my post.
Yeah, it's a very big conversation as to the idea that we've got social media deciding what is and isn't factually accurate. Not one that we're going to tackle in this particular interview, but I do want to get your thoughts, Phil, on this idea that we have an administration that's redefining a recession, seemingly more focused on spin than solutions, a Fed that assured us inflation was transitory. And given this, what is your outlook on the economy? I'm going to stick with the traditional definition and say we're already in a recession. What is your outlook on where we are now and what we can expect for the next 6 months and the next year, Phil?
Yeah, if we are not in a recession already, I think we are teetering on the edge of one. We're already starting to see other problems in addition to the GDP decline numbers that came through. Just seeing the Fed's after the fact, late to the action response, they are tightening up monetary policy finally, but they're doing so very rapidly and in a way that I think is dampening an effect of doing this in a more measured pace over the last year. And what that generally spells is that there are contractionary pressures that are underway and will probably be with us for at least a little while to come.
Michael, what is your outlook for the next second half of the year and first half of next year in terms of the economy?
Yeah, I don't want to wade into the argument about whether or not we're in a recession yet, and what the word definition of it is. How many legs does a dog have if you call his tail a leg? It doesn't make it one to call it a leg. But what I'll say is, if we aren't in a recession already, it is certain that we'll be in one, because with energy prices having gone up as much as they have, even after it is corrected the way it has, and with monetary policy, interest rates rising as rapidly as they have, we've never had that combination and not ended up in a recession. So it would be an amazing thing if we don't have a recession later this year or early next year.
Well, we do have markets rallying on this news, expecting the Fed to soften its position, even though we had two Fed presidents being very clear that they're actually not going to do that. We had the Federal Reserve Bank of Minneapolis President Neil Kashkari, who has been a longtime dove, now saying that he wants to raise the central bank interest rate to 3.9% by the end of this year and to 4.4% by the end of next year. Evans having a similar policy. He sees 3.4 rates this year, both pushing back on this market expectation for rate cuts next year. And yet the market seems to think the Fed is not going to go along with what these two Fed presidents say. Phil, what do you expect from the Fed come September and come the rest of the year?
Yeah, well, I can't tap into the mind of any of the individual Fed governors, but I do think that they are realizing that they've had a long-term crisis on their hand and they're playing catch up. That tells me that they'll probably stay the course of what they've been doing over the last month, just in a rapid, almost throw things at the wall to see what sticks type of an approach to fixing a problem that they stumbled into over the last year by really kind of being adrift.
Okay, but what does it mean in terms of the action, Phil, that you expect the Fed to take in terms of how many interest rate hikes do you think that we're going to see by the end of this year?
It's hard to say the exact number. I do think that there are going to be successive hikes that continue to play out. They're probably going to pace them out to try to absorb some of the negative shock, the backlash against that in the markets. And I think what we're seeing just over yesterday is a little bit of wishful thinking, celebratory thinking that the CPI numbers didn't turn out as bad as they could have been. But again, as we were saying earlier, this is not a win that we're celebrating here. This is making it through the inning without a run being scored.
Right. Not a win indeed. Michael, what do you expect from the Fed to try and engineer a win, to try and get inflation down to a more palatable number?
Yeah, I have to confess that I didn't think the Fed would be as aggressive as they have been. The Fed has learned to be dovish over a very long period of time, and to see them change their stripes is impressive. Having said that, the market hasn't really challenged them at all. We haven't had a nice sloppy sell-off. And I think that as long as we don't have a nice sloppy sell-off in stocks and bonds, I think the Fed will probably keep on tightening until it looks like inflation is coming down in a reasonable way, and that's quite a bit further than we are now. So I don't know where the Fed put is, but I think it has less to do with a level and more to do with, if markets start to get sort of sloppy on the downside, and as everyone realizes a recession is coming and money is getting tighter, then I think you'll see them back off some. But I agree with Phil. For now, it's they're going to keep going until something breaks.
Until something breaks, but not inflation per se. Until something breaks in terms of what, like 4 quarters of negative GDP growth. Will that make them agree that we're in a recession?
Well, I think that it's breaking markets or seriously breaking the economy. These guys have said that even with a recession, they'd sort of keep on tightening. And so I think that's what I mean by breaking. But I will also say that just moving interest rates without shrinking the balance sheet aggressively, they're not likely to get as big an impact as they would like to have from just moving interest rates, which they've never done before. They've never tried to restrain inflation with just interest rates and without restricting the quantity of money.
But they have started to taper off their purchases. You don't think that that's going to be aggressive enough? Would you expect more action there?
Well, they've started to shrink the balance sheet, but it's very, very slow. Yellen said a couple of years ago it would be like watching paint dry, and that part of their action is like watching paint dry. We'll have to wait and see whether or not money supply growth stays low as it has been for the last month or two. But unless it stays down for quite a while, it's going to be hard to restrain inflation without shrinking that balance sheet quite a bit.
Michael, I want to stick with you because, as I said, the markets seem to be pretty optimistic here. Some people are suggesting that we may have hit bottom in June. So what do you make of the green that we're seeing? Because we do have a lot of capital on the sidelines waiting to jump in. Some are starting to worry that, hey, if June was in fact the bottom, the FOMO is kicking in and they want to jump in now, whether it is or it isn't. It may create a false rally, a bear market rally. Is risk on in vogue again? Are we seeing a change in risk sentiment? What do you make of the way the market is perceiving this, Michael?
Well, I think that there is a definite desire to believe that the market should go higher than here. And we've been trained that way again for quite a long time, that you should buy all dips and so on. But, early on in inflation cycles, and especially we were coming off a period with extremely low rates and high inflation. And a lot of people responded to that by thinking that you should buy stocks because it's the only chance to keep up with inflation. As interest rates go higher and give an alternative, and as other things provide a better alternative, I think it'll get increasingly difficult for stocks to make much headway. I expect we'll see new lows before we see new highs.
All right. Now, Phil, we recently had Art Laffer on the show, and he said that the best way to reduce inflation is by tax cuts, by spurring production, supply side approach. What do you make of that?
Well, I think there's an interesting angle there. I don't see it as something likely that the Democratic Congress or the Biden administration will try. And I think that's become very obvious. I mean, we're really in this mess because of overspending. There is a nominal spending surge that occurred in the aftermath of COVID through all the stimuli packages, trillions of dollars basically injected, and no corresponding measure by the Federal Reserve on the monetary side to counteract that, to tighten monetary policy in return. So but basically, we've painted ourselves back into a corner through previous policy missteps on the fiscal side without a corresponding monetary correction through the Fed. And what that means basically is that, the political approach that the Biden administration has taken, unfortunately, is going to rule out anything on the tax cut side.
Well, definitely not, especially considering that the Senate passed the Inflation Reduction Act, which includes tax raises and includes $430 billion in spending, including $300 billion earmarked for climate change and clean energy schemes. Phil, Republicans are saying that this is only going to worsen the situation. What's your read on the impact of the Inflation Reduction Act?
Well, this is another exercise in Orwellian language. They're redefining terms. They're slapping Inflation Reduction Act on what's basically just a tax and spend package. It's just more of the same pattern that we've seen out of this White House going back from basically its inception. And the issue here is you can't spend your way out of months and months of missteps in economic policy. This is something that the Federal Reserve really got into the mess right now by essentially pretending that inflation was not even a problem. It was transitory, and in the meantime, they're focusing on things like ESG initiatives and trying to bring in climate change into the Federal Reserve's mandates. And Biden's making appointments to the Board of Governors that are primarily not monetary economists. They're political activist types that are interested in diversity initiatives, ESG spending. They're interested in climate change. So all these policies that the administration has prioritized has really shifted the Fed away from its historical dual mandate to focus on keeping employment stable, but more than anything else, price stability.
And Phil, the Republicans have also been very critical of a feature in the act which increases funding for the Internal Revenue Service, the IRS. That's going to go towards increased enforcement efforts like audits. I believe it's going to be raising their budget to $79.6 billion over the next 10 years. So we have individuals asked to tighten the belt while the government is increasing its spending with this huge increase for the IRS budget. Phil, what do you think the economic impact will be of this?
I was joking with a colleague the other day because the new bill is calling for 87,000 new IRS auditors hired. I have to actually wonder, is this the Biden administration's plan to counteract unemployment pressures that may emerge if we fall further into a recessionary pattern? It's hire them by the government and put them to work at collecting taxes.
Oh, all right, maybe that's a good spin on that. Actually, it's a way of job creation. Although there was some issue that the job advertisement indicated that there must be a willingness to use force, which has subsequently been retracted from that job posting. Michael, I do want to get your thoughts on what a retail investor can do in the situation. You're looking at this data, you're looking at the response by the Biden administration, by the Fed. What is the best move for a retail investor here?
Yeah, I think that what's really tragic about the investing landscape is that because it's been so long since we've seen inflation, there are not very many good inflation-related alternatives for a retail investor to be involved in. And if you're a wealthy investor who can go and invest in hedge funds, there are more options, but not terribly many. And so for a retail investor, of course, the first thing a retail investor should do is buy I-Series savings bonds, which is the best deal the federal government has ever offered. And it might be the only good deal the federal government has ever offered. But they're designed to float with inflation. Other inflation-linked bonds like TIPS are very good if you hold them to maturity. The problem is that in the meantime, as interest rates go up, you have losses. And so people who are investing in ETFs of inflation-linked bonds are seeing losses when they were hoping they were seeing gains. But for a retail investor, I think the main message is diversify away from stocks. They don't do well in inflationary periods. Diversify away from bonds. They don't do well in inflationary periods. And in fact, those two things tend to move together in inflationary periods. Diversify into broad commodity indices, not just precious metals, but precious metals, energy, agricultural, big broad indices like that. Own real estate if you can. But most importantly, sort of broaden your exposure to real things.
Real things, real assets like land then, Michael?
Like land, yes, land, and again, most investors should recognize that they do. If you own your home, you have a nice little inflation hedge built in. Your Social Security does have an inflation hedge built in. Your future in Social Security,
right?
And if you are young and working, then your future job wage increases are an inflation hedge. So, but for the money that you want to sit there and defend, putting it in stocks is really the wrong place to be. You shouldn't put it all in stocks and just hope that in the long run you keep up. You really should spread it out.
All right, Phil, I'm going to give you the final word here.
Well, the main thing I would stress here is that we need to actually pay attention to real economic effects and consequences of the policy decisions we've made over the past decade. Playing word games, trying to change definitions, trying to put political spin on new economic reports that come out, that's not going to address the core of the problem. And unfortunately, as long as the White House remains wedded to that strategy, we aren't going to get a really serious response to some serious and structural obstacles that we do have ahead of us.
All right, Phil, thank you so much. Phil Magness, Michael Ashton, appreciate you both joining us.
Thank you.
Thank you, Michelle.
And thank you for watching Kitco. Keep it right here.